good morning, fellow traders, and welcome to today's live trading session where we talk about what's happening in the market. We try to find some decent high probability setups also in the market. But I know today's meeting, we won't be with you guys for too long. We're just going to really share with you guys what we feel you need to know and then provide a few setups along the way. But other than that, I hope you guys had a pretty nice first few days of this week when it comes to trading. If not, then the week isn't over. Of course, we saw that the market was moving kind of slow for a good portion of the week. And then I think today we're going to really see some volatility kick in. We already see it to some degree, especially on a few pairs. And I'm looking at one of them right now, which is the Aussie yen. We're currently looking at the 1 hour chart. And this one right here was a setup that I was going to actually execute last night, but I actually executed a trade on another pair, which I'll talk about later. I may share it in the private, in the Discord group.
The profit section.
Yeah. But yeah, for the most part, we look at this pair. This is the Aussie yen, and we're currently on the 1 hour chart. We see that price is making higher highs and higher lows. It's pretty apparent. We're in a bullish environment. And what we want to do is look for an opportunity to buy on a dip or pullback in price. So then that is what we're going to look for on this case, because, we already know it's bullish on the 1 hour and it's also bullish on the 4 hour. We see this trend, this move to the upside. So then we want to stay on that side of the market. And if you look left, we don't really have anything to the left. Even if you go to the daily chart, we still have a ways to go before we hit this supply area right here. So then we can say that this could be a potential target right here. This could be our potential target right around this area. And we could say, hey, price could potentially push higher up into this area. So what we're going to do, we're going to mainly look for a pullback in price right now. Let me close this out because we don't really need this now. Or remove this take profit line. But what we're going to do is look for an opportunity to buy. But yeah, before we do that, good morning, everyone. Good morning, Stuart. Good morning, Naomi. Good day or hello to you, Joe. Hope all is well. So, all right. So then let's talk about this setup. So then what we're going to do is look for a buy on a dip in price. So then based on what happened when price expanded to the upside, where do you think we should look for the buyers at? I think it's pretty obvious. We have, of course, this hesitation candle right here, and then we have this one candle with this nice long wick to the downside. So then really our area of demand is really this entire zone right here. This is our area of demand where we expect the buyers to come in at. So anywhere within this zone, we're looking for that rotation in price to continue. So then for the most part, again, we'll be looking for price to pull back, retest this area as demand. And then we'll look to buy on bullish confirmation, and we can shoot for extended targets. If you're more of an aggressive type, you can maybe hold until we get all the way up to this area right here, which is around 96.45 or 43, around that area. You could just say 96.40. But yeah, we could also be conservative and just take what we can. But yeah, we're looking to buy. So we're going to buy the dip. So are there any questions on this one before we move forward? Remember, we're going to wait for price to come to us, and then we're going to pull the trigger. And, we're assuming that price is going to start correcting in a little bit. It doesn't have to. It could push higher. The reason why I say that is because if you was to draw out this move from here to here, and we can see price potentially expand. This is, the one-to-one measure move. We can see a deeper expansion to the upside, but this could also be a 236 or 382 measure move, which means that we can actually start seeing a correction now. So yeah, for that one, I'm just going to make this real quick. For that one, we'll just take our Fibonacci from here to here. We'll draw an arrow from the 100 to, let's just do the 38.2 for now. And that way we can identify, well, yeah, it could be turning anytime now, from this area all the way up to here is the zone where we could see price start switching. Let me do one more thing. Let me do this. So from here, because sometimes price does a 2, 3, 6 measure move. So all right, yep, did a 2, 3, 6 measure move perfectly a 2, 3, 6 measure move. So yeah, right here in this zone is where we could see price start reversing, and we can get that correction that we're looking for. So yeah, we're looking for a buy right about now. We're waiting for price to pull back. It could pull back anytime now, and we'll be ready, sitting right around this zone looking for our buy. So if there aren't any questions, then we can move forward. But are there any questions? Going once, going twice? Okay, so I don't think there's any questions. So then we're going to do one more pair, and I'm going to try to avoid the US dollar pairs, mainly due to the event risk that will come later on today. But let's do one that's very similar to this one, Kiwi yen. Kiwi yen is quite similar to the Aussie yen. We're in this bullish environment. It's bullish on the 1 hour, bullish also on the 4 hour. So yeah, we'll be looking for a buy on this particular pair. Where we would look to buy at, well, we have structure right here. Look left, structure leaves clues. We have a structure level, right around here, to the left. But we also have this hesitation candle with this nice wick. And then we have this candle right to the left of it with this nice wick. So then really this whole zone would be our area of demand right around here. So this will be our area of demand on the 1 hour, and we'll simply wait for price to come to us. We're not going to chase a trade. We're going to wait for the trade to come to us. And oftentimes price will give us a measured move to the upside, but it would also give us a measured pullback. And if we take this most recent pullback from this high all the way down to this low right there, take the measure move of this most recent pullback, and we superimpose that upon the high, that would take us right into this zone right here. So then from there, we're looking for a buy, and we'll look to buy on bullish confirmation, and we can just shoot for extended targets a little bit, maybe either a 2, 3, 6 measure move target, or a 127 fib target. But yeah, we're looking for the same thing. We're looking for a buy in this particular zone in this area right here. So yeah, this is the Kiwi yen. Are there any questions with this one? Okay, I don't think we have any questions for now. So yeah, so then I guess I'm done for now. I don't know, Mara, are you done? Did you want to take over?
Not done. I'll take it.
Okay, yeah. I was gonna say, yeah, I know you were reading something, but yeah, all right. So then, yeah, I'm done with this portion. Really, really brief, and I'm gonna let Marvin take over from now. Okay, so yeah, you guys know that today is an interesting day, a special day, because really the market this week has been waiting for a set of information or some data to come out, really from a plethora of central banks. But today's central bank announcement will be the first in what some are calling a central bank bonanza. Like this week is a bonanza of central bank statements that we have coming out, with the first one being today with the Federal Reserve. And we'll touch on why that's important in a little bit. But after the Federal Reserve bank announcement, we have the Swiss National Bank on tomorrow, followed by the Norges Bank, and then which is the Bank of Norway, and then also we have the Bank of England set to release their monetary policy decision or interest rate decision, and then the week is going to close off with the Bank of Japan. So then, of course, this explains why there has been limited volatility and a constraining of volatility even for most of this week, especially in the currencies sector. We've been seeing currencies, we've been seeing the dollar and certain major currencies confined within a range simply because there's so much event risk for later in the year. And if you guys know anything about asset prices or the reasons behind why currencies move the way they do, they move based on the market's expectation of where interest rates will go. Are market participants expecting interest rates to go up? Are they expecting central banks to hike interest rates? Or are they expecting central banks to cut interest rates? Are they expecting central banks to somehow manipulate the monetary supply to some degree? Because you got to keep in mind that the reason for central banks, or the purpose or the role of central banks, is to control the money supply. But the reasons why they control the money supply is based on two mandates. Especially, I can focus on the Fed. The Fed will mitigate and manage the monetary supply in order to control pricing pressures, or really control inflation, but also to help boost the labor market if they need to. But in this case, we're in a unique set of circumstances, or there's a unique backdrop behind today's announcement, simply because we haven't had a Fed statement for the past 2 months. You remember we had that break month in August where it was pretty much hiatus. We didn't get any policy statement in the month of August, but we're getting one now in September. So it'll be about almost 2 months since we had the Fed release some type of monetary policy statement. But what makes this a meeting important is that we're also getting the summary of economic projections, which means that, like, once every quarter, the Fed gets together and they readjust their economic projections based on the previous data that has come out. They try to assess, where do they feel like interest rates would go? Where do they feel like growth in the U.S. economy will go? So then this is the reason why this meeting is fairly important, and one of the reasons why we didn't see much movement or much enthusiasm in markets for the first 2 days of the week. And it's kind of like things have been reserved, or that volatility and market enthusiasm has been reserved until after today's announcement. But just like you guys know, this announcement is really carries 3 parts, or there's 3 areas of focus in today's Fed announcement. And I can probably just let me just do this real quick. I'm just going to pull up the economic docket so you can see for yourself. So let me just do this, change screen. Yeah, I know it's not bringing it up. Let me see what I can do. Had to open up Google Chrome real quick so I can show this screen. So give me a few okay, yeah, here it is right here. Okay, so yeah, I think you guys see it. Let me know if you guys don't see the screen. But what I want to do, I want to go to daily FX real quick, because I want to talk about the 3 areas of focus for today's monetary policy statement. And we may eventually have to bring up last June's statement in order to get the current economic projections that are out now. But as you can see, it's a light docket for today. We don't really have much in the U.S. docket. A lot of the activity will be reserved for later in the afternoon, or the U.S. afternoon, I should say. But we do have Bank of Canada summary of deliberations, coming out. That's almost like 30 minutes ahead of the Fed statement. So then really, I'm assuming this announcement would be sort of like a non-event. They're going to reserve any type of reactions because most of the market's focus would be on this statement. So then they're not going to move. Well, I don't know. It depends on what's written in this Bank of Canada summary of deliberations. But like, if it's impressive, then yes, we'll see some movement. But if it's sort of what policymakers and what economists have already been telegraphing or saying, then it's probably going to be a non-event. But either way, we're expecting the reaction to this news to come out following the reaction to all of this news. So then what I want to point out is today's Fed statement, Fed interest rate decision. What is the Fed going to do? Are they going to hike rates? Are they going to cut rates? Or are they going to stay on hold? And just like I talked about, or just like I mentioned before, there's 3 areas of focus that the market will be sort of looking to, and that we may also see surges and spurts in volatility. And that's the announcement itself, the interest rate decision itself. That's one. The second area will be on the update to their economic projections, their summary of economic projections. What will it be? Where are they forecasting growth? Where are they forecasting inflation would be in a year from now, 2 years, 3 years from now? And what's the updated dot plot? You remember the dot plot, which I may bring up later, which can show where the Fed expect interest rates to be, a few years from now, where the peak or the median rate would be within the next few years. So then those are that's number 2. That's the second area. And then the third area of focus would be Powell's press conference following the monetary policy announcement. So then there's 3 areas or 3 parts of this whole announcement, or this whole Fed how can I say, economic risk event or event risk that you will have to focus on, so that you can kind of see, okay, then the market is going to be very volatile because there's 3 focuses. There's the interest rate decision itself. There's the update to the dot plot and that summary of economic projections that happen quarterly. And then there's also the Powell press conference. And of course, we don't know what he would say or telegraph to the economy during the press conference. It may be different than what's written in the statement, or he may add a little bit more detail. So all eyes would be on the post-announcement press conference, which comes up like about 30 minutes after the statement is released. But right now we got to ask ourselves, okay, what is the market expecting the Fed to do? And what we can do is we can go to the CME Fed Watch tool. Let me just type that in, CME Fed Watch tool right here. And we haven't been here in a while, but the CME Fed Watch tool is really it's really a probability or an outlook of where the Fed funds rate will go or be based on the ZQ contracts or Fed funds futures contracts. Of course, we look at the market's activity or expectations surrounding ZQ, which is the Fed funds futures. And of course, with this CME Fed Watch tool, it's sort of estimates the probability of certain things happening. Like, will we see a rate hike or will we not for each meeting or for certain meetings? So then you can see here, if we look at this CME Fed Watch tool right here, you can see that, of course, right now there's like a 99% chance of the Fed holding, saying we're not going to hike rates, we're not going to cut rates, we're just going to keep rates on hold. And we can see here it's about a 1% chance that we'll see a 25 basis point rate hike for today's meeting. So then that's pretty interesting. And of course, as we go out, further towards the end of the year, we begin to see the market start pricing in maybe possibly one rate hike. But based on what we're seeing here, and even if I was to go to the other 2 meetings, and I may show this on the chart as well, like if we go to the price, the actual ZQ contract itself, we don't really see a huge pickup in odds of there being another rate hike, which is interesting. And I'll share a little bit later. But even for December, we see almost like a 60% chance of a hold. And we see roughly like close to a 40% chance of, the interest rate, of there being an interest rate hike. So then typically I like to see about a 55% from what I've studied, or even from what I've known from past times of looking at the CME Fed Watch tool. If we do get probabilities above 55%, then in general, in a broader consensus, or in a broader basis, we tend to see that policy move, or that expectation played out and become realized. We will tend to see either a rate hike or rate cut based on that 55% probability. But right here, it's about 40%. So we can't really say for sure whether we'll get a rate hike. 35% for an extra 25 basis point rate hike, about 4.75% for 50 basis points by the year's end. But if you look at, for the sake of time, I'm not going to go there because I may go there if we go back to to the chart. But right now, if we was to look at the ZQ contracts, Fed funds futures, which we will eventually go to on the chart, you'll see that for 2023, it's as if the market has sort of discounted any type of rate hikes. There will be no rate hikes for the remainder of 2023. But what's interesting is that what the market had priced in for 2024, we're not seeing the 4 rate cuts that have been forecasted for 2024. Because what some tend to believe, or what pretty much the Fed has sort of almost telegraphed to the market, it was as if the Fed is at the end of their rate hiking cycle, that we're almost near peak rates, and there will be no need to hike rates. If anything, they'll hold for a period of time, and then in 2024, then they'll have to start cutting rates, because we'll start seeing those recessionary pressures start working their way in, and the slowdown in the economy. And of course, you don't want to keep rates high in an economy that's sort of deteriorating, or collapsing, or imploding, in a sense, not in a bad sense, but slowly. So then, of course, what we've noticed is that the rate hike odds for 2024 have actually, no, let me say the rate cut odds have actually been cut. Instead of us seeing 4 rate cuts for next year, let me see if I can pull this up. Right here, of course, but let me just share this. Okay, for 2023, they had the median right here. This is the dot plot. The median is like around 5.5 for the interest rate. 5.5, which is, really, around the area we're at. We're at 5.25 to 5.5%. That's where the Fed funds rate is floating. So then we're there. And of course, for 2023, we're not seeing, based on this previous dot plot. Now, this is the dot plot from June's summary of economic projections. So then that was like how many months ago? Like 3 or 4 months ago. Like I'm, know I'm bad with the math, but it's about 3 months ago that we had this. Now, a lot can happen in 3 months. This could change for 2023. We could either see it, the Fed think that they may have to cut sooner, which I highly doubt, and this may drop lower. This median may drop lower, or it may tick higher, but I'm assuming that it's going to stay the same around the range that we're in, 5.25% to 5% for the Fed funds rate. But for 2024, you can see that the median Fed funds rate, the median projection has been brought lower for the peak rate for 2024. Almost pricing in about 4 rate cuts in 2024. However, when we get this new updated dot plot, this may change. We may actually see this median projection actually raised higher as the Fed and as fears of persistent inflation and pricing pressures continue to build traction in the economy. So then, why am I saying that there's a possibility that inflation may remain? And we talked about this before. Let me just pull this up. Let me just talk about, let me see, oil, energy prices. I don't know. I'm just going to do that. Okay. Let me just go to the news. Okay. So you see this, oil prices just hit a new 10-month high. What this could mean for your wallet. Gas prices hit 2023 highs as oil stays hot. So, just like I've showed you guys before in other, in screenshots and even in other webinars, we've been seeing this rally in oil. right now. And really, when you see a pickup in energy prices, that's also a pickup in inflation expectations. Like normally, when oil moves up, inflation expectations steam up and pick up as well. So then right now, we're seeing oil prices pick up. And this is happening on top of what we would have thought to see anyways. Even if oil prices didn't pick up, we expected to see the impact of base effects kick in towards this latter half of the year. And we was going to see some type of boost in inflation simply due to the effects of base effects, which is really more so mathematical than anything else. But the readings will come out more firmer simply because of the mathematics of base effects. And how we look at the year to year figures for our inflation figure. But as you can see, oil prices is picking up. Now, one thing you have to know about the Fed does not look to energy to determine what it wants to do with Fed funds rate. The Fed does not look at the inflation that considers energy. They more so focus on core services inflation, which is inflation that excludes food and energy prices. And the reasons for them doing it, I don't know. Like most people don't know the reason why the Fed don't really look to the two commodities or the two natural resources, you can say, that contribute the most to inflation. They sort of ignore that, but they focus on core services inflation. So for their monetary policy decisions, they look at core PCE data because that's the Fed's preferred inflation gauge. However, with oil prices rallying, that does impact inflation expectations. And that's one area that the Fed does focus on, inflation expectations. So then let's go back to our chart real quick so that we can why is this not showing up? Okay, let me do something real quick. Okay. Okay, so yeah, we're back here. Okay, so then, like I said before, the Fed, ignores, well, I wouldn't say they ignore it. They consider it, they're aware of it, but they don't make their decisions based on rallies in oil prices to say that, inflation is going to pick up simply because they feel like food and energy are volatile components of the CPI price index. They're volatile based on what season you're in, based on what's going on. So then for the Fed, they don't really focus so much on energy, but in some way they focus on it. How can I say it? I don't know if you want to use the word vicariously or they focus on it indirectly by looking at inflation expectations and what's happening with inflation expectations. So then let me do this real quick. I haven't gone here in a while, but let me just go to the daily chart real quick and let's see what the market is saying about inflation expectations. And we can also see inflation expectations in what we've been seeing with treasury yields as well, which we may touch on that because treasury yields have been rallying to the upside. They're at new cycle highs. And that could mean also that the market is expecting inflation to pick up since rates are picking up, because the only thing to counter higher pricing pressures is with higher rates, a higher premium for the US dollar. So then we're seeing interest rates pick up, which could be the market's way of front running any type of hawkish leaning from the Fed. So then we'll go to rates in a little bit, or treasury yields in a little bit. But what I want to touch on is expected inflation, US inflation expectations. So let's go right here to the 5-year break even inflation. And as you can see, it's been moving up generally, but we could see this steepening and it's moving up 2.3%, which is where we pretty much want the Fed inflation target to be, where the current Fed inflation target is at 2.3%. So then it's right, it's right there in 5 years, it'll be there. But as you can see, it's been sloping, moving to the upside. If we go to the 5-year forward inflation expectations, we're kind of seeing the same thing with inflation expectations starting to pick up. This is on the daily chart. So for the past few days, we've been seeing inflation expectations slowly pick up. They have here at 2.44% inflation in 5 years, which is close to the Fed's preferred inflation target, but slightly above it. And then we had the 10-year break evens, right here at 2.37%, just moving to the upside. So we can see the buildup in inflation expectations in these charts. But one way we can measure inflation expectations also is by looking at shorter and shorter dated treasury yields. And to some degree, we can also look at some of our longer term treasury yields as well. So then right now I'm going to go to the US United States 2-year treasury yield right here. And as you can see, it's above 5%. We went, shot up, tested above this cycle high. And of course, it's been stabilizing around the 5.1%, 5% handle. It's been stabilizing there. And let me just do this real quick so we can just remove this wick up here. But you can see it's at 5%. Now, inflation, interest rates have been picking up. And usually, the market response is more sensitive on the front end of the curve than the long end of the curve. So when we look at the front end of the curve, when we look at 2-year government bond yields, that's more reflective of where rates could go or what the Fed may do. So then the fact that we've been seeing this 2-year breach current cycle highs and reach new highs for 2023, that can be a sign that the market is believing that the Fed is going to have to be tighter for longer. They're going to have to hold interest rates high for a lot longer. And that if we do get a no rate cut or no rate hike and for this September meeting, then it would be a hawkish hold. It'll be a hawkish hold. We'll see the Fed maintain the interest rate at 5.25% to 5.5%, for the time being, but they will be vigilant and they're data dependent. And that's a new phrase that people are kind of throwing out, vigilant and they're data dependent. So which means is that they're going to say, well, of course, we're witnessing signs of inflation picking up. We see that in the price of oil, energy, but not only that, we have the United Auto Workers strike. And with the United Auto Workers strike, there's a likelihood that if that continues, that's going to help pick up inflation, because then we won't see the price of new cars pick up, not only new cars, but even used cars. The price of used cars would pick up as the supply of available automobiles tend to get taken up as these auto workers maintain strikes. So then there's this fear, or there's concern that with the auto workers strike, that's inflationary, and that we may see another tailwind to this whole inflation narrative pick up and gain steam throughout the remainder of the year. So then if the Fed sees that as a reason to be concerned, then we may have them telegraph and say, well, we're going to hold interest rates here, even though they may think that there's justification to hike by 25 basis points. But for the sake of not ruining their credibility and just maintaining what they've always communicated, they'll just say, well, we're going to hold, but we're going to maintain a hawkish rhetoric. We're going to keep rates higher and tight and monitor the impact of these higher rates on economic data. And they're going to say they're data dependent, and they'll make a decision on what they do with rates data by data, month by month. As the data comes out, they're dependent on the data, month to month data, for their forward guidance. So then that's what I'm expecting the Fed to do, because they don't want to ruin credibility. You remember, they ruined their credibility when they said that inflation was transitory back in 2021. They were saying, no, inflation will go away. What we see with pricing pressures and inflation, that's just a supply shock. That's just based on the lockdown. But as soon as people get back to work and the manufacturing engine starts priming up again, we should see supplies pick up, goods pick up, and then we'll see this inflation that, quote unquote, transitory inflation brought down to normal levels. But that did not happen. So then the Fed really lost a lot of cool points from that. So they don't want to ruin credibility by saying one thing and then that being the wrong policy response. They're going to play it carefully. They have to thread the needle carefully, because if they communicate that inflation is hot and picking up, and they communicate in a way where they mention that they will have to hike rates soon, then that's going to definitely be a shock to the market. That's going to result in stock markets collapsing, simply because stock markets don't like a high interest rate environment. That means that liquidity conditions are much tighter. There's not as much easy cash circulating around, and the cost for borrowing money is a lot more expensive, which means that companies are not going to be as busy, or not going to be able to grow and maintain business like they have, because the cost of capital is now more expensive with higher interest rates. So that's going to slow um, business growth, business activity is going to sort of slow down. Of course, some companies may have to result to layoffs as a result of the squeeze and the tightening that comes with higher interest rates. So then either way, if the Fed says or signals that they're going to hike rates, that's going to be negative for stocks. But also on the contrary, if the Fed signals that they're going to have to do an emergency rate cut real soon, or do a rate cut, then that may even cause more fear, because what they're saying, what they will be communicating to the market, is that the economy is a lot more worse than they had even assumed or thought of, for the Fed to have to cut rates now. So then that can be interpreted as we're in recession, or that could be the recession signal. And if that's the case, then we'll see stocks also tank and tumble, even though stocks in general love lower yields and they usually rally when there's rate cuts. But in this case, it's all about the reason behind the rate cuts. If the reason behind the rate cuts is due to fears that the market is slowing down, there's slowing growth, and that conditions may be a lot worse than many had assumed, then that's going to be negative. That's going to result in risk aversion, and we're going to see some flight to safety, or some rotation back into, safe havens. So then that's pretty much what the Fed has a tough job in how they're going to communicate. They're going to have to thread the needle carefully in order to not shock markets into selling off based on what they say, but so that markets can continue to sort of mope along. And as we've been seeing for the past few months, markets have, the equity markets have been pretty resilient. They've been really moving to the upside until recently. We had this correction, but they've been resilient even in the midst of rate hikes. We've been seeing stock markets move up, even when the Fed hiked interest rates by over 500 basis points in a little bit under a year, which is the fastest pace it's done in a long time. So then the market is pretty resilient. There's this optimism and this hope that traders have to still buy the dollar, since that's the cleanest shirt in the dirty laundry. The U.S. economy is still considered one of the best places to invest and park your money. Um, so then, so then that's that with this FOMC statement. Let me just move on to our ZQ, because let me just do this, because I know we haven't been able to do this. So then here's our ZQ contract for this year. The spread between the 30-day futures contract and our December 2023 contract. And as you can see, it's at 0.09. Like, it's slight rate hike, but really no rate hikes. It's really at zero. Like, we want to see it above 2.25, because you remember central banks hike by 25 basis point increment. So we want to see this above. So if it's not above this 0.25, then we know that for the rest of the year, this is what the market is expecting. There to be no rate hikes or rate cuts, but they're leaning towards the rate hike side. Since this is above zero, there's a slight preference and lean towards rate hikes. But to be honest with you, the market is pricing in no rate hikes. Now let's move on to, this is, I think, March. ZQH 2024, I think, is March, the March contract. So the spread between now and March 2024, we're still seeing hold. That means in March 2024, there will be no rate cuts from now until then. That's what the market is saying. Now the Fed can do anything. They don't really pay attention. Well, so they say. They don't pay attention to what the market's expectation is, because Fed funds futures is really what the market is implying the Fed should do. It is not what the Fed is going to do. We learn about what the Fed is going to do by their statement, by their economic projections, by looking directly at the Fed.gov or FederalReserve.gov, their website, in order to figure out what the Fed is thinking about doing. But this is the markets. This is the futures market expectation of where rate hike odds or rate policy would go. So then we can see that it's still at 0.09, which means no change, no rate hike, even up to the spring of 2024. But when we move further into, I think this is June of 2024, we see that it moved out of rate hike territory down to the rate cuts, which means there's going to be a slight preference towards rate cuts, but we're not seeing any rate cuts priced in even in June. It's at 10 basis points, 10 basis point of rate cuts, and they could technically do that, but you remember the Fed hikes and cuts by 25 basis point increments, so we want to see it brought down here to negative 0.25. So this is in June. So then let me just do this. Let me just go all the way to December of 2024. What's going to happen after June? So let's just do that. That's December Z 2024. That's a December contract. And as you could see, okay, yeah, I don't have this up here, but let me just do this right quick. This is our zero right here. Let me just, okay. So you can see here that it's definitely under under the zero, which means that we're in rate cut territory. And based on Fed funds futures, they're expecting 60 basis points of rate cuts before the end of 2024, which means there's going to be about 2 or 3 rate cuts priced in to the market that are currently priced into the market for 2024. This is the expectation of what we'll see in 2024. Now, you remember the Fed has their own dot plot, and we saw the dot plot. They had factored in about 4 basis points of rate cuts down to like about 4.25 to 4.5, interest rate. But as you can see here, based on this ZQ contract probabilities, outlooks have changed, and now they're only pricing in 60 basis points, which means that the Fed, 60 basis points of cuts, which means that the Fed is going to be higher for longer. They're going to have to keep rates higher because inflation is not going to roll over as quickly as many had hoped, or maybe they had planned. So for the time being, we're waiting for this announcement to come out. Let's see where the dollar is at the moment. We're going to first look at the Dixie. And let me just move this back to the candle. And I'm going to move this to maybe the 15-minute chart so we can see it on an intraday perspective. Right here. Okay, so then on an intraday perspective, we saw some dollar weakness, the dollar sell-off, but right now it's consolidating, which is typical. It's going to maintain this range possibly and consolidate until the afternoon, because this is important data. You remember there's 3 parts. There's the actual decision that, the interest rate decision when it comes out. Then there's the actual summary economic projections, which is the new update on growth and on inflation for 2023 and 2024 and 2025. And then there's also the press conference. So then we may see the dollar maintaining range. Now, let me go to the equally weighted index, or let me just hold this here, and I'm just going to pull up another window for the equally weighted index right here. Okay, the equally weighted index, US dollar equally weighted index. And you can see that it's negative. It's been sliding lower as well. But let's go to the 15-minute chart. And as you can see, yeah, there's still this downside pressure in the dollar. It's as if the market is sort of pre-positioning itself ahead of the announcement. it's kind of like the market is already, how can I say it, pricing in or repricing the dollar in anticipation of Powell's announcement, Powell's statement, just the Fed statement in general. So could this mean that, some traders believe that the Fed may not be as hawkish as maybe the market had presumed they'll be? And there's a possibility of that, but this could also be simply buy the rumor, sell the news in reverse. Like ahead of this major event risk, pretty much the dollar's going to sell off because they know that there may be a post announcement spike higher afterwards, especially if everyone is believing that the Fed is going to have this hawkish hold. They're going to hold interest rates at 5.25 to 5.5%, but they're going to actually carry a hawkish tone and talk about how they are concerned about inflation and they plan to keep rates as high for as long as possible to sort of help quell inflation and fulfill their dual mandate. So yeah, we should expect the Fed to touch on the labor market. We've been seeing some softness in the labor market, but to be honest with you, the U.S. labor market is still tight. And we haven't seen also wage growth pick up in the manner that we would like to in order to sort of help to account for or compensate for the rising inflation. So then, of course, the Fed has reasons to hike or stay tighter, but they also have reasons to cut in some parts. But with this recent case of oil rallying to the upside with energy prices wearing up, does that build more of a case for the Fed to lean more towards the hawkish side and say, we have to still, fulfill our mandate, which is to maintain price stability. And as long as we see oil prices rally, you remember higher energy factors into everything. It's the engine, it's the oil that fuels the global economy. It fuels manufacturing, just many things, transportation, like a lot depends on oil. So if we see oil prices go up, that's going to definitely, impact the cost of doing business, and businesses may have to cut back as well. So yeah, so right now, I would just say if I were you, trade what you see, not what you think. Of course, for me, I'm going to sit on the sideline. I'm not expecting to do anything more today. But I may just wait for that monetary policy decision to come out, and then possibly look for opportunities to trade either after the announcement, even though I highly doubt we will, because then there's the post-announcement press conference, and by the time that's over with, we're going to be close to the Wall Street close, the closing bell. So, but at least you can plan for the next day of trading. You can take where price will be positioned, where the dollar will be positioned, where assets will be positioned after the press conference and after the closing. You can determine where you think these assets would go or prices would go, considering the new statement that came out and even the new update to their economic projections. So yeah, so that's pretty much it. I don't really have much. Let's go to FinViz real quick. Let me just do this real quick so we can get an idea of what is the market sentiment. So I'm just gonna go here real quick. And by the way, we should talk about the United Auto Workers strike. Let me see the auto. I don't know, the worker strike right here. See any headlines for that? Although actually we may see that, even spill over into Canada. I know they're talking about going on strike, the auto workers there. But union gets tentative contract with Ford in Canada. What it means for you the kick. Okay, well, yeah. Okay, these are the latest headlines regarding that. But let's move on. Let's go to FinViz. Why am I? FinViz right here. And then let's go to our futures heat map. And as you can see for our futures heat map, you can see that U.S. Equity future benchmarks are still, slightly positive. You can see that the Dow is 80 points higher. The S&P 500 11 points according to this heat map. Even though there's a lag, we will have to go to the actual real price in order to see the real print. But for the most part, we're seeing these in the green, and we're seeing signs of what could seem to be risk appetite, slight risk appetite, or slight preference for U.S. equities ahead of the announcement. But we see that across the board globally, except for the Nikkei. The Nikkei fell by 100 basis points or 100 points for the session, but Euro Stoxx 50 rallied to the upside. DAX rallied to the upside. This is, 30 stocks from Germany, the top 30 out of Germany. The DAX futures moved to the upside, and we see VIX, this insurance, the volatility gauge that sort of measures the market fear. We see that selling off and pulling back as well. So it seems as if the market is not that anxious over today's news. That's kind of the way it's looking now, according to this heat map. It's as if they already know what the Fed is going to do. So then this announcement could be a nothing burger. We see crude oil slowing down and pulling back as well. So then, maybe that's kind of helping to fuel some of the demand in U.S. futures. But for the most part, it seems generally that there is, more assets trading higher, or than there are trading, lower. Even though the bulk of them are sort of neutral, but in some ways you can kind of see that risk appetite show up in this futures heat map. Now you can see here that gold, which is interesting. Gold is actually neutral. You remember gold is more of a byproduct of where yields are going. So if yields are going to remain elevated, treasury yields, real yields, then this is definitely going to put pressure on gold. But if you look at some of our other industrial metals, here in base metals, you can see that silver is in positive territory. You see copper, Dr. Copper moving higher, and then you see palladium also moving to the upside as the dollar weakens. You remember we saw the dollar, US dollar weak for the session. It's been selling off, so that should underpin many of our commodities that are denominated in US dollars. But you can see only a few, like these few metals are picking up, which are industrial metals, which could also help bring the market some reprieve and some enthusiasm, since there's been some growing caution of global slowdown and things like recession in Eurozone. So, but yeah, this is the futures heat map. Let's go to the Forex right here. The Forex heat map, you can see that according to this currency spectrum, the Aussie is the strongest currency for today, followed by the Kiwi and then the Euro. These two right here are high beta currencies. They're very sensitive to risk, and they move higher during moments of risk appetite. So it's interesting that they're the preferred currency, right now. But the weakest for today is the pound. I think that has a lot to do with what came out. We had some inflation data come out softer than anticipated, which cooled down the sterling. So then the pound came in softer, is one of the weaker currencies for the session, followed by the US dollar. And then the Japanese yen comes in at a close third for the weakest currencies. But the US dollar and Japanese yen are traditional safe haven currencies. And we can see that they're on the lower end of the spectrum, which means there's not much demand for safety. There seems to be more of the demand for risk in the FX space. And will we see that translated into the real market when the actual real, stock market opens? We may. According to the futures heat map, the futures markets are trading positive. So the hope is that that baton would be passed on to Wall Street when those indices open up for the day. But the US dollar and Japanese yen is selling off. So then, that's more indicative of risk appetite as well. But let's go to crypto. Let's see what's happening in the cryptocurrency space. And we can see here that according to this, even though certain heat maps are different, but we're seeing a sell-off with Litecoin leading the way lower, followed by XRP, Ripple, and then Bitcoin Cash. Bitcoin has been pretty volatile lately, and it's kind of hard to sort of figure out where it's going to land or what's going to happen. But I mean, we hear a lot of chatter. I'm expecting there to be possibly another spike to the upside, another surge rally. But I don't know. That's something that I haven't been following the news stories as much out of crypto because I've been focused on other assets and instruments and currency pairs. But yeah, like it's interesting that we have been seeing cryptocurrency markets suffer, and it seems as if there's this preference for more of our legacy assets, legacy havens, traditional stock market, like the traditional stock market. So yeah, but that's pretty much it. For now, I don't have much to share. I don't know if Melvin has anything he wants to share with the group, but I don't know. I think he's done for the session. I don't know. I think he stepped out, having to take care of some work. But yeah, I guess right now, let me see. Well, I guess that's pretty much it. I don't really have much to share. So then, yeah, of course, thank you guys so much for coming to today's session. Of course, we focus more on the fundamentals simply because this day is about central banks, it's about the Fed, and the Fed is really one of the major contributors to why asset prices move the way they do. And so then, of course, we have to give more time to that. But I hope you were able to grab something from today's session and at least learn something. What no, I won't do that. It's pretty good. You guys know that pretty much the Fed is expected to keep rates on hold. That's the overall market consensus. And we'll see, we'll follow their tone when that announcement comes out. But for the time being, just trade what you see. And thanks again so much for coming, for joining us for today's webinar. And like we always say, remember to always count your blessings, not your pips, not your points, even though it can be tempting to do so. But remember that there's greater reasons why we're here and we're alive, and we should put more of our focus and priority on those things. So yeah, count your blessings. It's still a blessing to be alive. But all right then. We may be in the private war room. We'll definitely send out an alert or send out a message if we do. But until we meet again, have a blessed day, and we'll talk to you guys later. All right. Okay. Yeah. Bye.